Hello and very warm welcome to all our dear students. We are on our last class today as far as the Forex is concerned. We have completed 5 lectures where the first 2 class were very conceptual and today's class are gonna be more practical oriented. So students, just give you a glimpse that what all we have done till now. I hope you had a great weekend and followed by today's class will be, I think, will be quite beneficial because we'll be concluding this session today. But again, it does not mean that you will have to only do the questions which I have shared on the assignment. You have to make sure that you are completing your study material as a whole. Okay, I mean, all the questions, all the illustrations need to cover up. So my first 2 classes were conceptual, where I taught you about the concepts of direct quote, indirect quote, European terms, American terms, base currency, what's the base currency, cross rates, and all those things were very, very conceptual. Followed by, we had certain concepts like a concept of forward contract. Okay, concept of forward contract basically means that the obligation to satisfy a particular currency, either to deliver it or either to accept it. That is a thing that we need to see that it is coming on time. And just in case the things does not happen as per the planned way, then what we do is either we go for a cancellation or we request for the extension of the contract. So that is very, very important. We have already covered in the last class. We had started with a new concept. Now I'll be giving you a glimpse again what we have done in the last class, just as a revision, because I understand must be busy with your weekend, with your Christmas celebration, all that. So just to give you a recapitulation what we have done in the hedges. Okay, just 5 minutes. Okay. So beta, here you can see, yeah. So the concepts which needs to be covered up in case over here is called as the hedging of foreign currency. I still remember a time that when Corona was not there, I mean, it never existed. So I always had a problem to explain the concept of, explain the meaning of hedging. What does hedging means? So when I used to explain students, hedging means protection. Protection means when you are driving a bike, you are putting a helmet. When you are driving a car, you are putting a seat belt. So now today, it becomes little more understandable that hedging is nothing but protection against the deadly virus. So that's the reason that we are wearing the mask. Similarly, hedging of the foreign currency basically means that what are the ways you can outperform with the market, in the sense that you need not to have any surprises that your foreign currency receivable or payable gets reduced or increased respectively. Okay, I'll come to that, don't worry. So just to take care of that, so in the question, beta, you could either be an exporter where you are exporting the things and you are receiving the foreign currency. Okay, foreign currency is received, isn't it? And you always wish to, when you receive something, you always wish to receive a higher amount. Okay, so this is the sorry. Okay, so you protect yourself against the lower receipts, so that adverse movement does not receive a lesser amount. So beta, if you are an importer, okay, if you are an importer, you will have to pay the foreign currency, right? Obviously, you will have to pay the foreign currency payment, okay? And in that, you are protection against higher payments. Okay? So this is what I taught in the last class, that this is how the things are gonna be as far as the questions are concerned. Again, beta, I'm telling you, this topic is extremely important. Need not to say again and again that I am not an examiner. I'm just an experienced teacher in SFM for the past so many years. This is an area which the examiner is testing your aptitude. And not only this, if we talk from the examiner side, he is on a beneficial side because of the fact that you have already studied the concept of derivatives in the last chapter from the other sir. So when you talk about derivatives, you have various type of derivatives like forwards. I'll come to all of them, nothing to worry. So you must have studied the concept of forwards, okay, followed by futures, then options, both will be your call option as well as the put. Examiner is testing your aptitude. Since you have already studied all those things, the examiner is expecting that you would be applying those concepts in the forex as well. You're getting my point? I repeat. So the concepts which you would have studied in your forwards, okay, in that that chapter, you are doing some other things, okay, like calculating the spot price, strike price, all those things, some different calculations. So here in the forex question, they will test you that whether you understand the concept of the derivatives. Okay, there you are buying a call option or you are buying a put option. Here, in terms of a foreign currency, what you will be doing, whether you will be buying a put or whether you will be buying a call, this will be covering up today. I will try and explain you in a simple, lucid manner, but still, again, the onus rests on you that how do you, do it while you are conducting these questions individually without any help. Okay, how you are doing it on your own way, self-based. Okay, so this is bit an importer or it could be an importer which could come in the examination. And what is the examiner is testing? How you can do the hedging. Okay, so hedging techniques, the question can come is you have to show it the forward contract. Means today you say that if I am an importer, I will make the payment at this much amount of money. Okay, I mean, if I say, let's say one spot $1 is equals to 70 and 71. Okay, so you will have to make a payment. You will buy the currency, bank will sell the currency. Now it's easy for you to understand. So you will take the ask rate. Okay, you are buying, bank is selling, and bank sells at the ask rate. So you said the spot price is 71 and the forward price is, let's say, 70.50 and 70.70. Okay. Oh no, 71. How can that be depreciated? Sorry. Yeah, 71.50. 71.50 and 71.70. So you say, okay, I will make the payment at 71.70 and the liability gets over. I don't want to take any tension. So this is how you have to do it in the exam. It becomes easy, not a problem. Second hedging technique, which is important, is the concept of futures. Okay. So as you would have studied your study material, okay, a very brilliantly explained concept of futures talks about that a wheat seller is supposed to sell the wheat. So to protect against the reduction in the price, he sells as many number of futures according to the contract size, the standard size, with the available quantity that he has. Okay. What did I say? I'll just tell you. Let's say one contract is for 1,000, say metric ton. Okay. And he has 20,000 metric ton in totality. So how many contracts he will sell? You would say, sir, simple, 20 contracts. Okay, this is how it is explained in the study material. So calculation of the number of contracts is very important in the exam. And further, whether you will be buying those futures or you will be selling those futures, that all depends on who are you. Who are you means either you could be an exporter or you could be an importer. All those things which I'm talking right now might be troubling you that it's going to be very tough. And honestly, it's very, very easy. It's very simple if you just apply your logical mind. And I have the full faith that you do have a very, very good and sound logical mind, better than me. That is why you are in CFI. Okay. So you just have to apply those logical things and you'll get full marks. Okay. So in the futures contract, you will be doing all these calculations for sure. Okay. And number 3 that is coming in the exam are the options. Okay. So option becomes little technical because of the fact that how would you do that? You will buy the call option or you will buy the put option, all depends which currency that they have given you in the exam. Sir, which currency means the base currency. Okay. So base currency will give you the idea as to either you have to buy the call option or buy the put option. That will be understood. And the fourth and the very, very important, the one which we have already started in the last class, is called as the money market hedge. Okay, I hope you remember that. Okay, so we have discussed about this thing. We'll be continuing with today's class with this only. You have any doubts, please let me know. And it's always good to see Akash morning. So Teju Akash, a very, very good morning, beta. I hope you're doing absolutely great. And one more student, sir, good morning. How to calculate the foreign exchange rate? Beta, I've already explained you in the last class. I think first and second class we have discussed about this, right? I hope you were present with us. I'm sure Sairam has been very, very proactive. I mean, that's the sense. Okay. So let me just explain, because he is a very dedicated student, there is no doubt, and he has been regular as well, so no doubt. So he's asking, sir, how do we calculate the foreign exchange rate? Beta, your answer remains very, very simple, that you have to use the concept of IRP. Yaad aaya? I hope you remember. In IRP, it talks about two things. Okay, I mean, what do you need in any rate? Either Sairam, beta, spot rate, or either you need a forward rate. So as per IRP, the interest rate parity, it talks about the concept of that you can say 1 by forward rate, 1 by spot rate. Sorry, spot rate is equals to 1 plus rate of interest of a country for which this calculation has been done. Okay, and 1 plus rate of interest of the other currency. So with this equation, Sairam, you can calculate either the forward rate or the spot rate. And there has been time in the exams. Listen carefully what I'm saying. There has been things in the past that the examiner has given you the forward rate and the spot rate, and they have asked you to calculate the interest rate as well. You're getting my point? So Sairam, your question becomes beneficial for the entire class. Do you have this understanding that what you have done? I mean, your question has given students more knowledge about the examination oriented questions. So students, with the help of IRP, it is not always essential that you will always be calculating either a forward rate or the spot rate. There are many questions in your study material and in the past examination as well, where the forward rates and spot rates are given, and you are supposed to calculate the rate of interest of any one other country. Okay, so either this country or let's say this country, and generally question comes for 4 marks. But again, when will that question come? I don't know. This attempt or the next 10 attempts, I really don't know. But it has come in the past, it might come again. Okay, any other question, guys? Doing absolutely great. Ciao. Thank you so much, Sairam. So first, should we quickly revise what we had done in the last class, because I understand there were 2 days break, okay, and there was a Christmas celebration as well, so give you the benefit of that. Okay, so beta, first we talk about the hedging and the concept of money market hedge. Okay, so here your story could be lined up in 2 things. Either you could be an importer or you could be an exporter. Okay, so I talked to you about the concept of importer first, and the other could be the exporter. If you remember, beta, so in those cases, when we talked about the importer, you have to follow the concept of the PLI, the government scheme, not that scheme, but it's just a short form how you can learn. So PLI, the full form means, since beta you are an importer, so you will be making a payment. Now I'll get little slow in my speech so that it is understandable. The importer is making a payment. So in that case, payment is a liability. Okay, payment is a liability. So liability has to be turned into an asset. And how does that asset becomes? By investing that amount. Investment. Okay. So this is the steps that we are doing. We had already covered in the last class. I hope you remember that. So there, I told you that there was a, let me explain you that. Okay. This was, I think Rahul was the name I had taken. Rahul is in India and the other person was John. He is in US. Okay. And he has imported, Rahul has imported goods worth $1,03,000. Okay. And Rahul is supposed to make the payment to John after 3 months. Okay. After 3 months. Clear? So this is how the things was shaped out. I gave you also the spot rate as well as the forward rate. So 1 by spot rate is equals to, I still remember, 70 and 71, and 1 forward rate was 71 and 72. And I told you which one is better. You were supposed to tell us. So what are the steps that we followed in this? I hope you remember all these data. So what all steps did we follow in that? Step number 1, okay, we have to calculate the present value, that how much should I deposit in today's John's bank, so that after 3 months it becomes exactly the amount which we are supposed to pay to John. So this was this was John, and this was his bank. Okay, so bank was giving us I think 8 to 10%. I don't know if I've taken that thing only. Okay. And I think 12 and 16% is what Indian Bank was paying us. So we said we first calculate the present value. Okay. We would first calculate the present value, means how much amount should we put in over here. Okay. How much amount should we put in over here, so that so that after 3 months, he give him exactly the amount of $1,03,000. So we calculated the present value. We said that the amount will be 1,03,000 divided by, let's say this is the deposit rate. Okay. And this is the, no, it was not 8, it was 12, because divide karke then only it will become 1 lakh. Let me increase it. Okay. 12 and 16%. Okay, let's take an example. So 12 was this. So he said 1.03. Okay, because this 12% is per annum. Okay, he is depositing, he is not lending that amount. So this becomes exactly $1 lakh today. Okay, so Rahul needs $1 lakh today. So the amount directly to John. Okay, clear? So guys, now he doesn't have this $1 lakh. So from where he will buy those $1 lakh, he will have to have the spot rate of 70 and 71 and 1 forward rate of 71 and 72. He will go to the bank and he will buy. If he's buying, the bank is selling, simple, and the bank sells at this rate. Okay, so he will convert this because he needs to borrow that. Okay, so how can he convert now? Because he doesn't have. Okay, so rupees required to put $1 lakh in John's bank account. Okay, bank account. Okay, so he will be borrowing this 1 lakh into 71, means he will be borrowing 71 lakh. Okay. And at what rate he will be borrowing? This is the deposit rate. This will be the borrowing rate. So he will be paying an interest on this. Okay. And amount of interest paid. So that becomes 71 lakh. Okay. 71 lakh into this 16%, right? So 1.04. I hope that's fine. 16 divided by 12 into 3. Okay, so 16 divided by 12 into 3. 4. So that becomes 71 lakh into 1.04. So he will be paying 73,84,000. Okay, this is what we had studied in the last class. Okay, nothing new as of now we have done. So we will be comparing these costs with others and then we'll get. Okay, guys. So I hope that is clear. So this we had done in context of the importer. Sorry. Okay. Now we'll be doing it for the concept of exporter. So any doubts, guys? Should I refresh my screen? Okay. Only those few questions that was asked in the start. You have any doubts? Please do let me know. Okay. Okay, so I'll wrap this. Okay, and we'll start with the next one, money market cover for the exporter. Okay, so for importer, I have given you a short form. For the exporter, you have to make yourself. Okay, so money market hedge. Okay, for the exporter. So how will we be doing these calculations? Let me just tell you very simply. So the data remains the same, beta, almost remains the same. Now we will change the names of them, okay, just for some differential things purposes. Okay, so let's put not Rahul, let's put what name should we take? I mean, very common name. Rahul is a very common name. And what name should we take? Should we take Akash? Okay, he's a very sincere student. Okay, so Akash is an exporter. Okay, he is an exporter. Okay, and he is exporting the goods to our another Sairam Limited. Okay, another student. So he's an exporter. He's exporting to Sairam Limited, and he is supposed to receive from Sairam. Let's take same example. Okay, $1,03,000. Okay, and rates remains almost same. Okay, let's say Sairam's bank is paying them 8 to 12%, and this is paying them say what rate you can take. Let's say 6% to 10%. Okay, 6% to 10%. Okay, guys, clear? No doubt still here. Okay, so now let's take those same rates. Okay, let's take those same rates. Why to change that? One forward rate is equals to 71 by 72. Okay, guys, clear? Now the examiner will ask you which option is better. Okay, let me change the color. Which option is better? Okay, number one, the forward cover. We call it as a forward cover. Okay, or money market cover. Okay, this you have to show it in the examination. So I hope no doubts in that. Forward is very simple. You can understand that easily. It's not a very big thing. In case of a forward, how much receipt we will get? Receipt under forward will be simple. He will be getting 1,03,000. Okay, multiply by how much, students? Is it clear now? 71 or 72? Which one needs to be taken? 71, obviously, because he will be getting those dollars. He will be going to the bank to sell it. If he is selling, the bank is buying, and then the bank will buy at this rate. Now this is, I hope this is clear. From the very first class, I have been stressing on that. So I hope that is clear to you. So 1,03,000 into 71 is equals to, that becomes 7,313,000. So 73,13,000 will be the amount of payment that he's supposed to do that. Okay, receipts. Now, beta, let's come to the next one, which is the concept of money market cover. And since he's an exporter, let's take an example that how we will be dealing that. In the previous example that I stated, right? Remember those? I said that he is a importer. He has to make the payment, and the payment is a liability that will be converted to an asset. Okay, this time since it's an asset, okay, it's a receipt. Okay, and receipt is always a asset. You have to convert this as a liability. Okay, RAL. It's a receipt. Receipt is always an asset. Convert this asset into a liability. And how do we convert an asset into a liability? By borrowing the amount that we are supposed to receive after those 3 months. Okay, I hope you are getting my point, beta. In the importer is the amount that he's supposed to pay it. Payment is a liability, and liability was converted into an asset. This is the rules of money market hedge. I mean, these are steps for the money market hedge. Okay, so in this case, it's a receipt. Receipt is always an asset, but that asset needs to be converted to a liability so that we can see how much money can we get. Why we are converting all this thing, you might be thinking. But we are converting all this because of only one thing, that taking the benefits of the difference in the interest rates. When we lend, borrow at a cheaper rate, okay, and pay at a higher rate, so it becomes easy for any person. Okay, so let's take an example that you say, you want to buy a mobile phone for, let's say, worth 20,000. Okay, you go to the showroom, any phone, Samsung, Realme, what is that company? Never Settle Valley, I don't know, whatever. So you go there and say, I have 20,000 rupees in my pocket, or let's say in your bank account. And you say that I want to buy a mobile phone worth this amount. I said, okay, fine. He said, sir, we also have a scheme which is going on. No cost EMI. Okay. Rather than paying this 20,000 directly, you can pay us 5,000 into 4. In 4 installments, we will not be charging any interest, no interest. So what you will do as a prudent chartered accountant student, okay, samajhdar, intelligent chartered accountant, said, why should I pay the complete outflow today? I will lose my opportunity cost. Why shouldn't I pay it in the EMI when the interest is not there? Or even if I say that the interest is there, okay, let's say he charges us 2%. मान लीजिए, just take an example. You say, still I am in a very win-win situation, because when I put this money in the bank, I am getting 7% per annum. Okay, and he's charging me 2% per annum. Still I earn 5% per annum. So it's good. Okay, so what we are doing is we are trying to manipulate the interest rate between the two, borrowing and the lending. Simply, there also, since two countries has different interest rate, we are seeing which option becomes better for us, either the money market hedge or the option futures, forwards, or without any hedge. Okay, that's what we are doing. So I hope this is clear, beta. We are coming back to the concept in a second now. So here it's an receipt being an asset and it into a liability. So now what we can do is we can the amount that we are supposed to receive, we will borrow it today itself. Okay, I will be getting 1,03,000 not today, after 3 months, 1, 2 and 3. I am borrowing that amount today. Okay, I will borrow that amount for 3 months. The repayment will be from the amount that I will be receiving. Okay, the amount that I will be receiving. From where will I borrow? I will borrow from this bank. Sairam's bank is the bank from which I will be borrowing it. Okay, and I will borrow today, and the repayment I will not make. Who am I? I am Akash. I am not making a payment. I am saying to Sairam, don't make the payment to me. Make the payment directly to the US bank. You're getting the point. I am borrowing the amount worth 1,03,000 which I'm supposed to receive after 3 months. From whom? From Sairam Limited. So I'm saying, Sairam, don't pay me. Akash is saying, don't pay me, brother. Just pay directly to the bank. Okay, after 3 months. So now your commitment is with your bank. There is no more commitment between you and me. Just make the payment to the bank on 3 months. I am going to the bank to borrow 1 lakh. Let's assume it becomes easy for Akash to borrow from the US bank. Practically, it becomes a little difficult, but let's assume that Akash is in such a position that he can borrow from a US bank. So he borrows from the US bank, from US bank, okay, at the rate of 12% per annum. Okay, how much is he borrowing it? He is borrowing 1,03,000. 1,03,000 divided by 1.03, because this is 12% per annum for 3 months. It becomes this thing. So he will be borrowing rupees 1 lakh. Finish. Simple. Okay, clear. Now you're getting a point. Why I've taken this 12%? This is a borrowing rate. This is the deposit rate. Okay. So Akash is not depositing any amount, beta. Akash is borrowing that amount. From whom? The US bank. And the repayment with interest will be worth 1,03,000. And that will be paid directly to Sairam and not by Sairam to Akash. He will be directly making the payment. So today itself, Akash receives that amount which he is supposed to receive after 3 months. Okay, although less amount, but he receives that amount. So how much does Akash receives? Now he has in his account $1 lakh. Can the bank deposit that 1 lakh? No, bank will deposit. He is in India. The bank can deposit the amount in Indian rupees. So he will go to the bank and he said, I want to convert this money. Said, okay, bank said, not a problem. What are you doing? He said, I have the money, I am selling it. The bank says, I will be buying it and I will buy at this rate. This is all happening in the spot today, as of today. Okay, 3 months is forward what he's supposed to make the payment, and Sairam will be directly making the payment. Akash is no more concerned with their transaction. He is free now. He receives 1 lakh today for the amount he's supposed to receive after 3 months worth 1,03,000. So he receives today, he goes to the bank and convert at the price of 70 lakhs. Okay, he receives 70 lakhs from the bank and he is happy to deposit that amount at the rate of 6% per annum. Okay, and how much amount does he receive after 3 months? So after 3 months, he receives how much? 70 lakhs into 1.02, I guess, right? I think so. Okay. Sorry, not 2, 1.15. Okay. So this is what he is getting, beta. Okay, 1.015 into 70 lakhs. So what is the worth amount he will be getting? 71.05 triple zero. Beta, he is an exporter. Okay, he is getting the receipt. Okay, he is getting the receipt. So now you can see carefully, the importer money market hedge was beneficial. In this question, forward cover is beneficial. Okay, because the spot rates premium is much higher than the interest rates premium. So as a result, he will be beneficial from the forward cover. So it is not always possible in the exam that the money market hedge will be beneficial. But still, you will have to show the calculation in the exam. Okay, it will not always the case that it will be beneficial. It will be beneficial only and only when the premium on the forward rates is much less than the premium in the currencies, in the interest rate between the countries. Okay, so in this case, you can see he's getting less amount in case of money market hedge. So he will be opting for a which color? Green color. Okay, so since receipt is higher in case of forward cover, he should take a forward cover rather a money market cover. But this is just, you have to show it in the exam and you will get the marks. Okay, students, bacha, any doubts, bache? Should I refresh it? Okay, no more questions. Okay, makes sense? Is it clear? This was the two conceptual thing because, beta, as I told you, the examiner can ask you futures, options, money market hedge. So money market cover you have not studied. So derivatives, you have already studied the concept of futures and option. So that is why I took over this case with you. I hope that works fine with you. Now can we move to the assignment? Just in case you don't have any doubts, we can move to the assignment questions. I hope you have the assignment. Just in case you don't have, you have not downloaded, I will show it on the screen once and then we can take you forward to the questions. Okay. So I'm rubbing all of this and so that we can take some other things as well. Okay. Okay, guys, so we have our question, yes, over here. I hope the screen is visible to you and we have already covered up our first and second question in the assignment. Today we'll be completing our question number 3 and the other question that I gave. Okay, beta? So let's take this forward. Okay. EFD Limited is an export business house. Okay. So exporter, now you understood. He is a person who would be receiving the money. So accordingly, he can do those calculations. The company prepares invoice in the customer's currency, obviously the foreign one. So that is why we have the foreign exchange fluctuation. I hope you remember, students, I told you in the last class, the two types of hedges, internal and external, are very, very important from the theory. Please do not be negligent to leave that, do it properly. And there are some kind of other exposures as well, translation, transaction, and the economic exposure. They have been given very beautifully in your study material. You don't need to refer any other material for that. Yeah, just in case you wish to have additional reading. So the RTPs and the past year's questions answers, which are issued by Board of Studies, ICI, time to time, you can refer that. Okay. Sometimes the answers are given in a more, bullet form manner, better than, generally in the study material, you have those paragraphs. So if you like bullet points, you can refer those things. Otherwise, no, any additional book is required. Okay. I hope you will have written that and you will be studying that for the exam. So its debtors is worth, my God, how much is this? Is 1 crore, I guess. 1 tens 100, 1,000, 10,000, 1 lakh, 10 lakh, 1 crore. Yeah, 1 crore. So 10 millions or 1 crore US dollars he's supposed to receive, which is due on 1st April. And 1st April, market information as on 1st January is there. So he's supposed to receive after 3 months. Okay. What's next? The exchange rates are given. So now we have the futures. Okay. So futures have come now. Okay. We will take the benefit of understanding futures with this question. Okay. So spot rate is given to you, beta. Future rate is given to you. Okay. Are we supposed to apply the cross rates? No, thank God. Okay. The exchange rates are per INR, spot rate is given to you. Okay. So the base currency is US dollars. Okay. But the exchange rates are different. So we will see how we can do that. Spot 1 month forward is given to you. 3 months forward is given to you. This is futures. This is the contract size. This is 1 month forward, 1 month futures, 3 months futures. What is this initial margin? I will explain you. Okay. And interest rate in India are this. In 1 month's time, you get 6.5 and 3 months time, you get 7%. On 1st April, the spot rate is 0.01636 and the future rate is 0.16134. Okay, clear? Okay, so which one would be more advantageous? Okay, no hedging, a forward contract, or a currency future. So I hope you will able to do this in exam. Okay, so we have three choices. Shall we study for this? Any doubts, Pita? Let me just check if there is any doubts on this. Okay, no doubt as of now. Okay. Okay, one student is asking, sir, when it came. Yeah, I'll just tell you. It came in your November 2016 exam. This is your November 2016 question. Okay, a recent one, but again, that's not relevant because you never know when you will be getting the next question in which year. Okay, so chale start kare. Okay, okay. So we can do little bit over here, and then we can do the rest one little forward. Just 1 second, huh? Just 1 second. The first one, when what if he is not doing any hedging? Okay, first is no hedging. Okay, no hedging means, what does that mean? It means simple that he is not going for anything. Okay, he is not going for anything. No forwards, no money market hedge, no futures. He receives the amount after 3 months. Okay, so this is 1st April. Okay, this is EFD Limited, and he receives the amount on 1st April. How much? 10 millions US dollars. Okay, and he's not going for any kind of hedge or something. He goes for no hedge. So how much he received? Okay, receives how much? 10 millions are there. Okay, and the base currency is in INR. Okay, and the rate is in the rate is in INR. The base currency is US dollars. So will we divide it or will we multiply it? Simple. I come again. The base currency is US dollars. Okay, the base currency is US dollars, and the rates which are given to are per INR. Okay. But again, I told you in the exams, this could confuse you that, sir, whether it is a code or a symbol. Okay, whether it's a code or a symbol, again you have to apply your common sense. Okay, how can US dollars be lower than Indian currency? So it becomes a logical thing. So this is given to us as dollars per INR. So we will divide with this amount. You are getting my point. So we are saying simply that we are not doing any hedging. On a particular date, we saw what is a spot rate. Okay, and that time the spot rate was 0.16667. Okay, and after 3 months, this was the rate. So how much did we receive? We have to just show it this one calculation to the examiner, and our work will be over. Okay, so 10 millions divided by 0.016136. Oh my God, it's a big number. So let me write over 61973,227.57. Okay. Done. So this is the amount that you will be receiving without hedging the without hedging your currency. So this was simple, straightforward, no much technicality over here. Next is that you are taking a forward cover. Okay. Next is that you are taking a forward cover. So let me write it over here. So once he's taking a second one, that is a forward cover. Okay, so how much is he will be receiving? He will be taking a 3 months forward. Okay, 3 months forward. So 10 lakhs. Okay, 1 million, 10 million, sorry, not 10 lakhs, 10 millions or 1 crore will be this rate. Sir, one question. Yes, beta. Sir, we are not given bid or ask rate. That becomes easier. The examiner is giving you just one rate, so that becomes easier. When it will be little challenging, when he will be giving you the bid and the ask, then you are supposed to see that whether we are buying and bank is selling, or we are selling and the bank is buying. So here it becomes easier. 3 months forward rate, what is quoted by the bank is 0.016129. Okay, so we are taking that cover today, when we are taking it on 1st of January. And whatever is the spot price, we are not concerned. We will be getting a fixed amount after 3 months. So we will be taking this as a divide. Why? Because again, you can see this is given as per the US dollars per INR. And our base currency is US dollars. And if they don't match, we divide. And if they matches, we multiply. 16129. Okay. How much amount we'll get, beta? 0.016129. Oh wow, such a big number. 62,000,124 point, exactly, almost 000 numbers. Okay, so this is what you will be getting. So I hope you had the first number, something, I think 6197 something, and 62. We are an exporter, okay? We have to receive the amount. So the higher the better. If you are an importer, we have to pay the amount, the lower the better. Okay, cash inflow and cash outflow. This I'm sure you know. You have done numerous questions on importer and exporter in CA Inter. So no need to be worried about that. Okay guys, so 62 something is what we are getting here. 6197 was we are getting over there. It's easy till here, not a problem. I hope so. Now comes the little thing that you need to understand. The concept of future. Again, as sir also said in the class when he came, I think first or second class, that we will not be going into the concept of futures in detail. Okay, futures in detail. We will be doing the computation based on what we are supposed to do that. Okay, so now I am rubbing this. I am taking you to the whiteboard. Okay, I'm taking you to the whiteboard now so that you are able to understand that. Concept of future. See, futures basically help us to protect our downside. Okay. So the example that is given in your derivative chapter, I'm not talking about the derivative chapter, I'm just telling you that the example which is quoted in your derivative chapter. Okay, what does it say? It says very simple that there is a wheat seller. Okay, or let's say, why should he say seller? He's a producer. Okay, wheat producer. He wants to sell it in the open market. Clear? Yes or no? Okay. What is he most terrified about? Okay, किस बात का डर है? What is he most terrified about? Anybody could tell me? Just 1 second. Put on the charging, right? Okay. So what he is concerned? He is concerned about only one thing, that the price of the wheat, okay, can go down. And he will be receiving a lower amount. Clear? Simple. What he do is, he makes a future contract. Okay. Now, in your exam, there could be two challenges. Okay. Number one, in this chapter as well in the derivatives chapter. Number one, whether we have to buy the future or we have to sell the future. This is the most difficult thing to, I would say. Only this thing is difficult. Otherwise, then it's a very simple and sober calculations. Nothing much is there. So you have to buy the future contract or sell it. That's the biggest thing. Okay. There it becomes easier. There means the example that I quoted over here, it becomes easier. Why? Because if the price has to be fixed, you will sell future contract. When you sell a future contract, okay, based on the number of quantity that you have, that I explained you, the contract size, all those things, you are basically locking your price. Locking the price, sorry. Lock in the price. Clear? Lock in price means beta, you are just putting that amount, okay, that in your bank account directly. I mean to say that no more fluctuations can impact your receipts. Okay, if the price goes down, okay, you have sold the future price will also go down, and you will make money on that from the futures market. If the price goes up, okay, you can sell that in the open market and you will get the benefit of that. So I hope you remember this concept. If somebody don't remember it, just tell me, I will recapitulate that amount. Is it clear, guys? Have you, still aware what we were doing it? Okay. So what you are doing is, let's take an example, very simple one. You have one contract of 1000 metric ton. Okay, I'm explaining you. I'm assuming that you don't know. Or even if you know, then just revise it. Okay, and he has 1000 metric ton. Okay, this person is also having 1000 metric ton. So it becomes simple. He sells one contract in futures market. Why? Because it's a standardized one. You have to follow the exchange rules. Okay, and he fixed the price at, say, 100. He has 1000 metric ton. One contract is 1000 metric ton, and he wants to sell it 100. Okay, simple. Now there could be two situations in the real life. Either this price could go to 125 or let's say 95. Okay. He fixes up his price at 100. So if the price goes to 125, what will happen? He will go to the market, okay, and he will make a profit. 125 minus 100. He wants to sell at this, which is 25. And he will have a M2M loss in the future. How much? 125 minus 100, that is 25. So his net position remains nil, means no change on that. If the price is 95, so he goes in the market and sells it at 95, he makes a loss of rupees 5. And the future has been sold, the price has come down. So he will knock off his position, square off his position by selling at 100 and buying at 95, because the price converges with your market price. So he will make a gain of 5 rupees. So he will have no profit loss. So with the help of futures, I just want to say that you are trying to lock in the price at 100 rupees. So the price becomes from 100 to 150. Then also you will be selling at the same price, or it becomes from 100 becomes to 80 rupees. Then also you will have those same amount of receipt. This is the benefit of having a future contract. So sir, now is it relevant in your forex also? No, it is not at all relevant. Sir, why? But only the concept of future is relevant. Now you will not be dealing with all these because you are dealing with the foreign currency. Okay, sir. So let me take you to that quickly now. Okay, no more wastage of the time. So here we have given the futures. Okay, and it's a receipt. So why am I selling this future? Now everybody is clear. Generally, when I teach this question in the class to the students, they always have a difficulty understanding, sir, why did you sell it? Future हमने sell क्यों किया? Why did we sell the future? So students think that we need to ratify the things always. No, beta, not always. I have taken you back to the basics of derivatives. Why do we sell the futures? When we are having a receipt. So here also we are an exporter. We have to receive $10 million and we will be selling the future. Clear? We will be selling the futures and we sell the futures. Okay, sell the futures. And we sell the futures of US dollars. Can we say, beta, that we are buying rupee futures? Sir, I told you now. In the second class, yes, sir. You remember one thing? Sir, don't remember much. Okay. This is me. This is a bank. Okay, yes. I want to go to the US. Wow, sir. Oh, no example. Yes, sir. So I have to go to the US, or for that I have to buy $100 or let's say $1,000 from the bank. Clear? If I say if I am buying dollars, okay, what I am doing? I am selling INR. Understood? No, sir. If I want to buy, I don't have a item to sell. Yeah. If I am buying a mouse, computer mouse, not the rat. Okay. I am selling my INR. Is it clear or not? Yes, sir. I am taking out 500 rupees from my pocket. Okay, I am taking 500 rupees from my pocket to buy this. So am I selling that or not? Yes, sir. So I am selling the INR to buy the mouse. So that's the reason I am selling the INR to buy the dollars. This is what I explained in the last class. Sorry, in the second class. So I hope that you remember that situation, guys. Clear? So in this case, since I am selling the futures, can I say that I am buying dollars? Buying INR? Buying INR. Yes or no? Yes, sir. But sir, tell me one thing. क्या बेटा? Sir, why is there need to say? हमें जरूरत क्या है? Why do we need to say this? I am telling you why we need to say this. You want to know why did I say this? Yes, sir. This you know that it's a receivable of US dollars. So we have to sell the futures of US dollars or we have to buy the INR. Clear? Yes, sir. Now I'll tell you the reason why I'm talking about this, why we are doing that. Come back to the assignment. Okay. The currency that you can see, the futures currency is given you in INR. Oh, yeah. We have been dividing this. Why? Because the base currency is something different and the given currency is different. Okay, sir. Sir, in case they would have given us directly USD, we will be selling it. Yes, you will be selling. Okay. Achha, sir, we have cleared the concept that we are buying and selling. That is clear. But sir, what we are doing with this buying and selling? Dekho beta. You are buying or selling a future. You are buying or selling a future on a current date. Yes, sir. It has a time period. Yes, sir. Say 3 months. Yes, sir. So don't you square off your positions? Yes, sir. The derivative you sold today, you buy it on the expiry date, or the derivative you bought today, you sell it at the expiry date. Getting my point? Okay. So that's the reason that if we are selling today, we have to square off the position and see what is the gain or loss we have made in trading in the derivatives. We are not, although trading, we are hedging in the derivatives, but still we have to know that what is the M2M amount that we received or have to be paid. Clear? Clear. Now coming back, what we have done is, in this question, let me give you the entire thing, just in case you joined right now. Okay. We talked about the concept of no hedging. The amount was something 61.97. Then we talked about the concept of forwards. Okay. The forwards that we are supposed to take, what is the receipt on that? Third one is that we are taking a future. And it's a receipt. We have to sell US dollars. And if you have to sell the US dollars, we have to buy INR. Why we are buying INR? Because the rates are given with the base currency being US dollars, but the rates which are given to are per INR rates. So we are buying the INR futures. Clear? Clear, sir. So can we understand now what is the value needs to be hedged? Yes, sir. Okay. So the first thing is okay. Should I rub all this, right? So the first thing is you have to sell USD futures or buy the INR futures. Clear? Now, what is the value to be hedged? Okay. Now see carefully. Value to be hedged. Kitna value ko hedge karna? What is the value to be hedged? What this amount will be calculated in, whether dollars or INR. Think about a minute. Think about a minute. Sir, obviously we are hedging the dollars. Yes, you are right. Conceptually, you are absolutely right that we are trying to hedge the dollar. But as of now, we are buying the INR future. Sir, come again. Yeah, I come again. You are, although hedging a dollar, the dollar of 10 millions. That is clear to us. But you will have to calculate the value of the hedge in rupee terms. Sir, why? Because we are buying INR futures. Why? Okay, sir. Value to be hedged, although is in dollars, but since we are buying the INR futures, the value will be calculated in rupees terms. Clear? Yes. So what is the value, beta? Sir, the contract size is 24816,917. That is okay. And this is contract sizes in rupees. Can you see, everyone? Yes, sir. And what is the future price? Can we see that future price? 3 months, this price. So this is getting little confused. No, but there is nothing to confuse yourself. Just focus on what I am writing there, and you will understand that very easily. Okay. That is why I have not chosen so many questions that I have to rush into that. I will cover the entire course with you within this time frame so that it is understandable, right? Okay, sir. So now the thing is, yes, sir. First, I will calculate the value to be hedged. 10 million 0.016118. Clear? Why? Because the base currency is US dollars and this rate is given in per INR. This concept is clear? Yes, sir. Then I will get how much value do we need to hedged. So let's see, 0.016118. Clear, beta? Yes. This is the value to be hedged? Yes. So the very first thing that you have been doing in portfolio management and derivative chapter is the calculation of the hedge ratio. You know now how to calculate a hedge ratio? Very important from exams. Okay. So hedge ratio, you know the formula. Okay. The numerator and denominator. Okay. Divided by all those things. Okay. I hope you remember that. If not, then please refer that. It's very important. So this is the value to be hedged. Okay. And what is the number of futures that will be requiring? Okay. Number of futures, or let's say number of contracts. So number of contracts. But just in case you are having any problems in this, it simply shows that you are not very perfect in derivatives. So you have to be very perfect in derivatives. Then only this chapter will be more understandable. Otherwise, if you think that I can pass through derivatives without studying derivatives, I can do forex. No, that is not possible. Okay. Yeah, forex you can do, and derivatives forex you can leave, and forex derivatives you can do. But without derivatives, you cannot do forex. Okay. So number of contracts required is 62042437 whole divided by this 24816,975. Okay. So divided by 24816,975. So it is exactly coming out to be 25 contracts. I hope that is clear, beta. It's a zero equal, right? Okay. 25 contracts. Has everybody checked these calculations? Any doubts, students? Refresh kar deta hu. I'll just refresh it. Okay. Very good question, Naveen. You always make me happy, really. So guys, Naveen Prakash has asked a very good question. Okay, so you can ask me question even if I'm doing something in the middle. I will be happy to explain that. Sir, how to identify the contract is for USD or INR? This is what I have been explaining with that. Okay, the very simple thing is, see, today we are doing, as of now we are doing future. Again, you will have a problem for, this problem will come for options as well. Whether you have to buy a call option or whether you have to sell the whether you have to buy the call option or whether you have to buy the put option. Call option gives you a right to sell. Put option gives you a right to buy at those prices. Okay, so that is the thing that we need to see from here. That it all depends upon. See, number one thing is that if you are a exporter, okay, Naveen, but you will be receiving the amount. So to hedge that, you will sell the futures. This you have studied in your derivative chapter, so I am not elaborating this much. I've explained with the help of that VTrader example. So this you know. So you have to by default sell USD INR, but since the USD INR futures is given in rupees form, so you are selling dollars, or you can say you are buying INR. Getting my point? This is what we are supposed to do. Okay, students, this is clear? Fine. So now let's understand what is the next step that we are supposed to do. I hope that is clear, Naveen. And Mr. Naveen will be covering up more things in your options as well. So stay tuned for that. Okay. So this becomes easy. In this case, let me just, you've written till here, beta. Okay. So can we move to this thing? Whiteboard. So I am saying sell USD futures or buy INR futures value to be hedged this one was there. One six. I hope everybody has written it properly. So 6204-24370. So number of contracts. Okay. This happens. This is all happening on 1st January. This is all happening on the 1st of January. Got it? So now what we can do is, let's understand. Before we enter into this contract, you need to pay some upfront margin money. See, in the real life, there are two types of margins. One is called as the span margin, okay, and one is called the exposure margin. So do we need to learn this now? So what we need to learn? In your derivative chapter, there are two types of margins. One is called as the annual margin and one is called as the maintenance margin. Okay. So that is also very important in the exam. Please do all these things. Okay. Don't forget to do this. So margin money is what is supposed to be paid, which is based on per contracts. Okay. Per contract you are supposed to pay. You are getting the point? A contract लेने पर, one contract you have to pay multiples of that. So let's take an example. One contract has a value of, let's say, 7,000. So for, let's say, 10-1, you have to pay 70,000. And from where will you get this 70,000? We will assume that you don't have those $70,000 with you. You will be borrowing from the bank. Or even if you have, you will have to take its opportunity cost. You're getting my point? So this money you don't have, you either use your opportunity cost or you borrow from the bank. So in this question, since the examiner has given you, where is that question? Yeah, he has given you the margin amount and the interest rate in India. So you can calculate. If you're taking a 1 month, so you are paying 17,500, and if you are taking a 3 months, you have to pay 22,500. So how much margin you will have to pay, beta? You are taking 25 contracts, multiply by 22,500. Clear? And you will be paying zero, I forgot. 5625. Okay, 5625. So in this case, you are paying this amount and you are assuming that you are borrowing this amount, and you are borrowing from the bank at the rate of 7% per annum. Okay, so how much did you pay? Has anybody calculated? Okay, so you will be paying for 3 months. Okay, so the interest on this will be 562,500 percentage into 3 by 12. Oh, simple, not very much. Okay, so it becomes 9844. Okay, 43.75. So you can take this. Iska treatment will be doing it little later. Don't worry. I've just calculated and set aside this figure. Okay, we don't need to do it right now. We'll do it after 1 or 2 steps. Is it clear till here, beta? Should I take you back to the question? Okay, so margin money bulk per contract you have already calculated. Okay, now becomes the main calculations. But the concept of M2M, gain or loss, that needs to be seen. Okay, so on 1st April, what happens is you are having the receipt from the customer. Okay, received. How much amount did you receive? Obviously, same. How can it change? Okay, and what is the M2M gain or loss that you paid? Okay, see this step very carefully. Okay, there are two sides of the coin. One is sell and one is a buy. We have bought INR future, not sold them. Getting my point, guys? Students, is it clear? We bought at 0.016118. And at what price did we sell it? Let's check it from the assignment. We sold, what is the, we will be squaring of the position and what is the closing price of that? You're getting my point? This is what we had bought for. This is bought and this is sold. Sir, why are we selling this? Better to square off your position. Can you keep this futures for forever? No. Only to the tenure for which you have your contract. You're getting your money in 3 months, you're taking a 3 months future. Okay? Sure. I know this is little tough, but that's what tough life is. You have to deal with it. You just can't ignore it. So that's the sense. So now you can verify, see, verify. Let me just refresh. I hope there's no other questions further. Yeah, till here. Okay, thank you, Naveen. So nice of you. Clear to him. Very good. Okay. So we buy something at 0.16118. Okay, means we buy at 118. We sell at 134. Oh, bought at lower price, sold at a higher price. Wow, we got a gain. We got a gain. Clear? Done? $1,6,134. Okay. So what is the difference that is there? One six, okay, into number of contracts, beta, okay, 25. Here it is there, okay. The number of contracts is this, and the value per contract, okay. 246 something, I guess. 248,816,975. So this is my M2M gain. All these calculations are in INR. Okay. Oh, sorry. All these calculations are in dollars. Okay. All these calculations, because this is in dollars amount. These are all dollar amount. Okay. Dollar, and multiplying that. So into 25 into 24816,975. So we made a gain of $9926.79. Is it clear, guys? So when we add this to 1,000,9926.79. Clear? Clear till here? Okay. Now what we will be doing that we have got our total dollars, we have received our M2M gain also. So where we will convert this dollars into INR. Okay. And what price will we take? We will take the spot price. Clear, beta? The one we use for the no hedging wala. You remember? So we will be using this rate 1.16136 so that we can know how much amount did we receive in INR. Okay. So sorry. Can I rub all this, right? Because this is you have already know. This is what our sorry, not 836. Sorry. Okay, this is what we have received in on 1st April, or you can say 31st March. Clear? So how much did we receive beta in INR? Divided by 0.016136. Clear? So it becomes 62034747 Clear? And we less the interest on this margin money. This 9844. Okay, we can reduce this. Six two zero three three 762 68729. What? Looks like even a bigger than a phone number, my god. Okay. Or let's say make it 77. That's much better. Okay. Okay. So I think highest is this one. It was 61.97 in case of no hedging. It was 62 something in case of this forward contract, and it's 62.03 in case of a future contract. Clear, guys? So we can say zero 03, right? It will be preferred. Why? Since the outflow is inflow. Okay. Since the cash inflow will be highest in that case. Okay, clear guys? No doubts? I will take up one question, beta. There is a question, okay, and then I will move to the next topic. The question is from Naveen Prakash only. He says, "Sir, why do we have differences in the spot and the future rate? If I am not wrong, futures on expiry." No, you are absolutely correct, Naveen. Who says that you are wrong? You are absolutely correct. What you have studied in your derivative chapter is the right concept, that the price of future and spot converges, okay, and it matches with that. So let me take you to your question. Why should I? Okay, but there is not much difference actually. Okay, firstly, there are always certain differences because of some exchange differences. So there is not much difference. It is 0.36 and 0.34. So almost they are same. In real life, yes, they converges exactly. But there are times where there is a difference in the amount from paisa wise or something. Okay, that's the same. So although it is same, you can ignore. It's an exam question. It's not a real life question. But your concept is absolutely correct and absolutely great, that the price of spot and the future converges as it comes near the expiry. Okay, beta? So difference is there, but you can ignore that. Okay, clear, beta? Any further doubts? So let me know. Otherwise, we can move to the next question. Okay. Should I wait for you? The other time, I'll just put my charger. Fine. Okay. So shall we move ahead, beta? One more question before we go for the break, right? We have time for the break. Okay. So no further questions. Naveen, let me know if it was clear, beta. Okay. In questions, generally practicality could be little ahead, but not a problem. Okay. So now we're coming to the question number 4, which is again a very nicely framed question, and a very similar question. What you can see is in your study material as well, the one you can see on your screen. A very similar question is in your study material. I think question number 39 is, if I remember correctly. So it's a very similar question, and it came in your examination in November 2015. Okay, should we read that? XYZ, an Indian firm. Okay, we need to pay. Okay, now we are not an exporter, we are an importer, and we have to make the payment. Clear? Of how much? 5 lakh Japanese yen. And as I told you in the very first class, in the very first hour, Japanese yen is not stronger than INR, it is weaker than INR. Okay, so just sometimes logic works in the exam. Okay, so in order to hedge the risk involved in the foreign currency transaction, the firm is considering 2 alternative methods. One is called as the forward market cover and the currency option contract. Okay, so on 1st April, the following quotation, Japanese yen per INR are, spot is this. Oh, now the bid and ask rates have come across. This could be challenging in your exams as well. If you are given a single rate in the exam, then you should be in a very happy situation. But if the bid ask is given, then you have to be little vigilant. It's not tough, but you have to be vigilant. And there is a 3 months forward which is given. This is the price that you can see. Okay. Oh, option is there. Oh my God. Oh, let's see. So now, in the previous question, we had three methods. Okay, one was the no hedge, second was a forward, and third one was a this thing your futures. In today's this example, this you have given the options. Okay, so thank you, Sairam, for the nice words. Okay. Naveen is saying, okay, sir, thank you. So when the question isn't talking about future rate, can we Naveen, you're a champion. You're a champion. Sairam in the morning helped a lot of people. Now with your question, you have helped a lot of people. I'll take up what you're saying. You're absolutely correct. And you are a brilliant mind. Okay? I'll tell you for other students, they'll be very anxious that what am I talking about? I'll talk about this in just 2 minutes. What he's trying to guide us and he's trying to confirm whether he's correct. Yes, you are correct. I'll tell you what he's saying. First, let me complete this. This question has that you have to compare the payments because you are an importer here. Okay, so you will have to see where your cash outflow will be lower with the help of a forward market cover or the options. Previously, it was no hedging, okay, forward cover and the futures. So you see where the payment was highest. So you had selected that. This one, you have only two things to work, which is a forward market cover and the currency options contract, and you can say where your cash outflow will be less. Okay, clear? So let me complete this. Price of the foreign currency options on purchase are as follows. Strike price is this. Call option, if you buy for June contract, you will have to pay this much amount of premium. Sir, what is a premium? Derivative class. Sir, please tell us. Because the amount that you give or you receive, that means if you are a call or a put holder, means buyer, you pay the premium and you get the benefit of buying or selling a particular currency or asset class at the desired price at the desired date. Okay. If you're selling the means writing the options, you will have to either sell the asset if you have short the call option, and if you have short the put option, then you have the obligation to buy that. Okay, clear? Put option is June, this one. So you will have to pay the premium if you're buying a call option, and you will have to pay the premium if you are buying the put option. For excess or balance of Japanese covered, it would use the forward as the future spot rate. So this is your question, Naveen ji. This is your answer. So just in case you don't have this is what he is saying. Yes, if you don't have that rate, what rate you can use? Okay, because the examiner will always give you one is a spot rate and one is a forward rate, Naveen. Okay, but you cannot say that you can take future rate what you have written. Okay, thank you. Isn't future can be used as spot rate, but there will always be a difference. Okay, there will always be a difference. So if the question is giving you spot rate and a forward rate, and in this question, in a question you have futures also, futures market also. If the future rate is not given, you can take a forward rate, but you cannot take a spot rate. You're getting the point? I repeat. You can take two rates will definitely be given by the examiner, either with bid or ask or without bid or ask, single rate. One will be a spot rate, one will be a forward rate, or let's say one will be a future rate. Okay, so you can use these two rates interchangeably. Okay, but you can't use this rate with this rate because that becomes practically impossible that the currency did not move for 3 months or 6 months or 1 month, whatever the time tenure is. So if it says future may after 3 months, what is the future rate? We don't know, not a problem. You can take the forward rate as the future rate because the forward rate will be the spot rate after 3 months. Listen carefully. Your forward rate after 3 months will become spot rate of that time. So it will converge with your futures so that you can take equal. But spot rate you can't take. And it will never be possible in the exam that the examiner is not giving you spot rate and the future rate. He will give you spot rate for sure, and either future rate or forward rate he will give for sure. You don't need to worry. Okay. Okay, one more question. I'm liking today, a lot of questions are coming by Mr. Sairam. Sir, in previous question, can we pay margin amount? Sir, in previous question, can we pay margin amount borrowed from bank? But this is what I assumed. See, when you pay a margin money to make any trading, from where do you give that amount? Either you have your money yourself, okay? I mean, the money is there in your bank account, so you take the opportunity cost, okay? Or you assume that you do not have a money, so you are borrowing from the bank. And once you are borrowing from the bank, you are paying the interest, okay? 3 months interest was given as 7%, Saira. 1 month interest rate was given as 6.5%. That was given to confuse you. Okay. So you will be assuming that you are borrowing that, say 22,500 per contract, means multiply by 25, multiply by 7% as the amount of interest that you are paying, because you will be dealing in the future. 3 months interest will be paid. I hope that's clear. If the examiner is not giving you the interest rates, he will definitely give you a opportunity cost. Okay. And if just in case no rates are given, a student asks me, sir, do we assume the rates? It's better you don't assume any rates, because that will increase your working. You just simply say that this is a margin required and no money has been borrowed or any opportunity cost is taken, on a simpler note. You can give the note in the examination as a assumption you have taken. Okay. Okay, guys, I'm liking a lot of questions are coming. Very nice. So can we start with this question, beta, if you allow me so? Okay, it's almost 8:37 now. Let us take it forward. Okay. Okay, this one is fine. Can I rub this? Okay. Okay, how do we start this question? It's simpler as against, any other. I will explain you. So I hope you have written all this. So beta, what we are doing is we have to see which will result is a lower cash outflow. Okay, company is an importer, so amount is payable in Japanese yen. Okay, the one that results into a lower will be chosen. Will be chosen. Clear? So first, he's taking a forward cover. Okay, yes, sir. Hold your breath. You have to take the rates now. Clear? Yes, sir. Beta, what is the base currency? Sir, Japanese yen. What is the rates which are given to you? Sir, are they symbols or are they codes? Again, beta, apply your logic. I told you in the very first class, Japanese yen is little weaker than Indian currency. You remember that? So, you are taking a 3 months forward rate. These are the rates that you need to do. This is per INR. This is Japanese yen. Okay, this is INR, this is Japanese yen, so you will divide. This is clear? Okay, yes, sir. Now, which rates are we supposed to take? This is little challenging, little one. But if you have attended your second class properly, you could have managed with that. Okay? Clear? Yes, sir. So I am an importer. I have to pay. Okay? So to pay, I will buy. The bank will sell. Okay? XYZ will buy. Bank will sell. Therefore, ask rates. Clear? Ask rates are clear? No doubt. Okay? Now, the base currency is this, we have to divide. Okay? So it has to be ask rates. Okay? But this is, we have to divide as I written it over here. So can I say amount into 1 by bid? Here for Japanese yen to INR. Not clear? Okay. See this carefully again. XYZ will be buying the currency because it needs to make the payment. The bank will sell it. We are buying, we are XYZ Indian firm. We are buying, bank is selling, and bank sells at the ask rate. Clear? Yes, sir. So the ask rate, although, just wait, should be this one. This is a bid rate, this is the ask rate. Okay, okay, sir. So it should be amount into the ask rate. Yes, sir. But this is given per INR. So we have to reverse it. Just we have done it in the cross rates. How do we reverse it? We do it 1 by bid. Okay, of the Japanese yen. And we take the bid rate as 1.9726. I hope this is clear to everybody, or everybody. So 9726. Clear? So 5 lakh. Clear, beta? So amount this will. Then I will take up your doubt just in case you have any. $472. Clear? Easy? Not a problem. Second, okay, before I go, I think there are some doubts. Yes, sir, done. Thank you, Sairam. Okay, sir, in previous question, can we, okay, this is done, right? Yeah, okay. I thought there's any new question. Okay. Should I refresh it? Okay, clear. No question still since past 10 minutes. This is clear with that first one. Bid ask can be little confusing in the exam. But again, if you practice that properly, I mean, honestly, if you attend this lecture now very carefully, you will cover up 80% of your chapter. 20% I'm saying because that is your self-study. Okay? So this is clear. I've tried to cover up each and every question with you, to be very honest. Okay, this is a forward cover. Okay. Second will be the options. Okay. Now understand carefully. Okay. This is again little challenge. Options. Okay. Company is an importer. So he has to pay. Okay. So company pay in Japanese yen. Okay. So company will buy Japanese yen. Obviously, Japanese yen they will buy, then only they will have to pay by selling INR. Jeb say they will debit their currency, home currency INR, then only they will able to buy. Okay, clear? So I can say what gives us the right to buy call option of Japanese yen? What gives us the right to sell? Put option of INR. Is it clear or not? Call option of Japanese yen, or you can say put option of the INR. Put gives me a right to sell. Call gives me a right to buy. I'm paying the premium. Okay, I'm paying the premium. If the price increases to that, I exercise a call option or I let it lapse. Clear or not? What did you understood in the derivative chapter? So let's say there is a stock called ICICI Bank. Okay, currently trading at, let's say, 730 rupees. You want to buy it at 750. You paid a premium of 3 rupees. If the price crosses at 750, then you will exercise the right. If the price closes at 748, you will let it lapse. Why would you pay something at 740? Why would you buy something at 750 when it is available in the open market at 748? Okay, why would you pay higher? So you let it lapse, this becomes 0. So call option gives you a right to buy. Similarly, put option, it gives you a right to sell. You exercise only when it is beneficial, otherwise you just let it go. So these are the two things. Yes, sir. You will be asking, sir, why did you write this call option of Japanese yen and put option of the INR? Beta, because we have to see in the exam what is the option is available in what terms. Okay, just the way we did in the previous question, the futures were given in the INR. We have to see what ways the option is given. Okay, see in exam. Options are available on what terms? Okay, rupee per Japanese yen or Japanese yen per rupee. Per rupee, okay, per. If it is per Japanese yen, you will buy the call option. If it is per INR, you will buy the put option. I cannot make it more simpler than this, beta. The only thing is you have to practice and practice. Or see this question at least twice or thrice. Then only you will be able to understand. Coming back, you are an importer, you have to pay the amount. Pay Japanese yen. So how would you pay someone? By buying a call option of Japanese yen, which gives you a right to buy, or by selling the INR, which gives you a power to buy Japanese yen when you pay INR. Getting a point? So call option of Japanese yen or put option of INR. All depends in the exam that the options are available on what terms, bhai. So should we see what terms is it available? Oh, it is given in the see carefully, okay? Japanese yen per INR. See. Can you identify? This was the question asked by Naveen Prakash as well few minutes back. How do we identify? This is the thing. So either buy the call option of Japanese yen, but is it given? No, sir. Sir, ये दिया तो हुआ है. It is given. Beta, this is Japanese yen means this is per rupee. Per rupee. So you will have to buy the put option, which will give you the right to sell INR. I repeat, you will have to buy the put option so that you can have a right to sell INR. If you sell INR, you will buy the Japanese. I hope is that clear, guys? Is it clear? Coming back to the whiteboard. Okay, so this is what it is given. So we will take the put option of the INR. Okay, and how do we acquire the INR? By paying the premium. Okay, now is this clear? We have to take the put option. Okay, I'm rubbing this so that we are able to complete this question here itself. Funny sound, huh? Okay, chalo. So therefore we will buy put options. Okay, okay. Number of options required, number of contracts. 5 lakh is what the thing is, divided by taking it to the assignment with the number of options and the premium, how much we are supposed to pay. So this is the strike price, 2.125. Okay, and since they are buying the put option, you will have to pay this much amount of premium. Okay, this is per rupees. Okay, this is all are in per rupees. So 2.125. This is also in Japanese yen. So this Japanese yen get cancelled. We get number of contracts. Oh God, a little higher number. So 294 contracts that you have to take. Okay, very little will be the one which will be a little unhedged. Otherwise, whole will be hedged. Okay, amount of premium to be paid 235, 294 into 0.098 was it, right? The put option, okay, the put option. So how much will it comes to beta? Japanese yen, how much you will have to pay? Two three zero 58 point. Should I take 59? Okay, on the round off. Okay. So one another challenging thing over here, just very small. To buy the Japanese yen, you have to pay some Japanese yen premium as well. This is the premium per rupee, means in Japanese yen you will be paying. How much per rupee are you paying the Japanese yen? So you will have to pay 23,059 as the premium amount. Clear? Yeah. So you will go to the bank? Yes, sir. So you will be, why I'm smiling? Because this is little challenge again. You're getting the point. You will have to pay the premium in Japanese yen. So you'll have to buy Japanese yen, that also. I mean to say, along with the 5 lakh Japanese yen, you will have to pay this also. Okay. And what price you will be buying that? Okay. Can we see that? Yes, sir. Okay. So you have to buy 23,000 something 59 as the premium amount. Okay. So how much you will have to pay for that premium? You are doing all this transaction in the spot? Yes, sir. So here we took this rate, 1 by bid? Yes, sir. So rate will remain same here like this. Sir, come again? Yeah. You have to pay the premium on options in Japanese yen. So you will buy Japanese yen. If you will buy, the bank will sell. So if they sell, the rate will be asked rate. But you have to divide that. You will take or 1 by bid rate. Okay, so you will pay the Japanese yen option premium 23059 divided by 1.9516. Clear? No doubts? Okay. So amount of rupee required to pay option premium 1.9516. Just be careful with these symbols, okay, what I'm writing. This is the above one was in Japanese yen. Now what I'm paying is in 11815. That is in INR. Clear? Okay, that's it. And what else? On the expiry, since you've already paid the premium, you can buy the currency at the desired price. Okay, this is clear. So can I rub all this? Any figure that we require from here? No, 119815 only. Okay. On expiry, whatever price of currency B, okay, company has a right to buy Japanese yen, okay, or we can say sell INR, okay, at 2.125. Clear? This is what the rate is. You want to see? Is it beneficial or not to do that? Yes, 2.125. Okay, they can buy at this price. That is the reason we have taken an option that gives me a right, whatever the price is, that gives me a right to buy at this price. Clear? 11815. Just 1 second, huh? Just 1 second. Okay, is it beneficial or not? Yes, sir. Why? See, and it is beneficial to exercise the option. How come? See, on expiry, the rate is another one point. I mean, he's taking future spot rate. Okay, he says over here, na, see, future spot rate. So the rate is 1.9726. I have to pay. Okay, I have to pay that amount. You want to check? You can check. On expiry, so you could take 1.9726 as the price, okay, or 2.125. If you take this rate, you will have to end up paying 5 lakh divided by 1.9726, or if you take this, you have to pay 2.125. This will ask you to pay 2,53,000 something, 477 what we calculated, and this gives you a right to make a payment at 235,294. Which one is better? Sir, this one is better. Why? Because it's a cash outflow. Okay. But you're forgetting one thing. Sir, premium. Yes, premium. Okay, this is all are in INR. Okay, so it is beneficial to exercise the option. Okay, so calculation of cash outflow. Number one, payment 5 lakh divided 2.125. Sir, will there be any question where we are not exercising that? Yes, sir, we will be doing today. Yes. Okay. So you are paying 235, 294, and you are also paying the premium 11815, if you remember. So your net payment becomes, which is still better than your forward, 109. Okay. Since option results lower cash outflow, it is preferred over forward. In forward, you are paying this amount. In option, you are paying this amount even after paying the premium as well. Clear? So this is how you have to show it in the exam. I hope that is clear. Can we have a break in case you don't have any doubts, Beta? Any doubts? I hope I'm able to explain you the things. Although they are tough, but again, becomes easy when you are do that, right? Easily. And now we are taking up our next question. Okay. SI Limited, okay, a US firm and US firm, sorry, will need to pay. Okay, so we are again an importer, okay, and we need to make the payment. Okay, so see, students, even if you think that the classes could have been more, just in case a thought was there, but I promise that I have covered the entire content with you. I have covered up the concept of receivable, payable, the concept of money market hedge, forward contract, option contract, futures. Okay. You might think that the money market contract was not done practically. Okay. I gave you an example in the perspective of an importer and exporter, but you can understand that from this question for sure. Okay. And if some time will be left in today's class, we might do the revision of the content. Okay. So a firm needs to make a payment. So again, payment is the liability. So it has to become the asset by investing this amount. Okay. So money market hedge becomes your PLI. Okay. Government's PLI, I have taken it as it's their trademark, but I have taken it. Anyhow, so beta, the following information is available. 1 pound is equals to as much as twice of the dollars. Okay, so now you have to make an understanding that you are in US, okay, and you have to make a payment in the UK. How much? 3 lakh pounds. Getting my point? Okay. 180 forward rates are given and spot rate are given. As I told you that this will be given by the examiner. Okay. Second thing is that which a lot of students are not very comfortable with. I'll just tell you what it is. They have given a 180 days deposit rates. Okay, so sometimes students have a confusion that, sir, is it a per annum rate or not? See, beta, this is your study material question. If you would have been from the old course, it is your practice manual question. Again, a very gem question, I would say rather. So in this case, if the examiner is rightly giving you 180 days, then how can you assume it's a per annum rate? So take it as a exact rate. I mean, you don't need to make any calculation of 6 by 12, okay? Because it's already given as a 180 days rates, okay? So don't assume it at a per annum. If nothing is given, if this line is not given and deposit rate is given, then you can assume in the exam that this is per annum. But since he has given it directly, it's a 180 days rate, so take it as a 180 days. Okay, clear? Okay. And call option on the pound, okay, not the dollar, okay? A call option on the pound that expires when he days has exercise price of 1.97 and you have to pay the premium of 0.04. Clear? X Limited has forecasted a spot rate of 180 days, hence it could be 1.91 having a probability of 25%. It could be 1.95 having a probability of 60% and 2.05 having a probability of 15%. Which of the following strategies would be more preferable? Okay, you'll be preferring hedging, you'll be preferring, no hedging, forward contract, money market hedge, or the option contract. Show the calculation in each of the case. Very important, 8 marks question of the exam. Okay, so shall we continue? If there is any doubts, please let me know. No doubts? Okay. So this is again your November 2015 November question and very, very relevant. Should I refresh? In SFM? Yes, you're absolutely correct. I told you, na, this is your SFM. So yes, he's absolutely right. Question number 39 is what it is. I've taken it from there. Okay. So I will just, whenever I revise, I just see that is study also has given that same solution so that I'm in synchronized with that. I don't want to take any assumption which is in contradiction with the study material because our Bible, our base is study, right? So that is why I have told you that. Thank you, Sairam. So shall we start now? Okay, let's go. So beta, here 4 things are required. Okay, that's easy. That's not a problem. 4 things are required, and you need to calculate each of them separately. That's not a problem. But the thing is, majorly, you need to see how spot rate needs to be taken. Whether you have to take the spot rate which is given as 2, or you have to take some other rate. That is the main concern. Okay. So when it says no hedging, okay, when it says no hedging, then you need to understand, can we do it below that maybe, right? I think so. Yeah, we can do here, but we will have to remove all this, right? We can do here also. Okay. Okay, let's do it on the whiteboard. That will be much easier. Okay. So A part. So first of all, before we directly start the A part of B part, let's try a solution. Since company is importer located in US, okay? payment resulting in lowest cash outflow will be chosen. So number 1A, no hedging. Okay, no hedging. Just in case they do not hedge their currency. So what rate should we be taking? Should we take the forward rate? Because only spot rate and forward rates are given. So that becomes incorrect if we take the same rate in forward also and in no hedging also. So no hedging, expected rate to be 1.91. What was that? 91 ka 25%, 95 it is 60%, and 2.05 is 15%. Okay. Clear now? So can we calculate this? I'm just taking the total, okay? So let me clear my memory of the calculator. %. Okay, so guys, rate is coming out to be 1.955. Has everybody got this rate? Okay, no problem. Has everybody got this rate? 1.91. Oh, okay. I've written 25. Huh? Thank you so much. This is 25, right? Yeah, 25. Sorry. Okay, 25, 60, and 15%. Okay, 1.95. Somebody thinks that no, we are not getting that. So I thought why it is coming out to be that. Okay, clear? So this is your expected rate. So you would expect the market to be at cash outflow will be payment was how much? 3 lakh pound, I think, right? Okay, 9.55. So 1.955. So that will result in a cash outflow of dollars. This is now your home currency, dollars. You are a US firm, okay? So you will have to pay 5,86,500 if you're not going for any hedge, okay? Second one, B. If you are taking a forward cover, okay? So forward rate you can see, it's simply given, beta. 1.96. Directly just multiply and save your time simply. So the higher the amount, the worse it will be. The lower the amount, the better it will be. Because we are an importer, we have to make the payment. Okay, do not forget that. So out of above only 2, I do not find forward to be lucrative because it results in higher cash outflow, right? This is the sense. Okay, so what about others? Let's understand this. Okay, for C we have to do the money market hedge, so for that I will have to rub the entire book. Okay, I hope you have written this. So C, money market cover. So since you are an importer, you have to make the payment, which is a liability. So convert this into an asset by making an investment. Okay, this is what we have been doing it from a while. Okay, so beta, the thing is, how much are you supposed to make a payment? Sir, we have to make a payment of pound 3 lakh. Okay, so what should we deposit now? Now understand, because I have already explained you money market cover with an example. Now this is a full-fledged question. Okay, now understand properly. This is you in US. Okay, this is your creditor to whom you have to make the payment in UK. How much you have to pay? 3 lakh pounds. You can see the deposit rates over there, so that you would say how much should be invested. Okay, 180 days rates are given to you. Should I take you with the rates? Just 1 second. Okay, so deposit rate, borrowing rate, both are given to you. Clear? Not a doubt. So you have to make sure you are investing that amount, right? You have to make a payment, but you are making investment right now. How much should we put in? What should be a present value today? That how, if you put in, becomes that amount after the deposit. Okay, na? So let's take an amount is, if I put today, this is today in UK bank, how much should we put it present value, so that this is the interest which I'll get deposit 180 days. Okay, 180 days. Okay, how much amount we put in today, so that it becomes equals to exactly 3 lakh pound by dividing that. Okay, so we can divide 3 lakh with 1.45. It's not a per annum rate, beta. It's not a per annum rate. It's a 180 days. Clear? This rate we have to do. So is it clear, present value concept? Putting the money today, so that after 6 months, means after 180 days, it becomes exactly $3 lakh. 3 lakh pounds, sorry. 3 lakh pounds. Clear? Should we go there? Clear? So how much should we deposit it? In 180 days. Okay, so we can say we are calculating the present value. Okay, so it becomes 3 lakh divided by 1.045. It's a 180 days rate, okay, not per annum rate. Please don't make a mistake. This is also a similar way the study material has done this. Okay, clear? Chalo. So, if you deposit today pounds 287,081, roughly. If you deposit today 2,87,081 pounds in the UK bank account, so the importer, this person will get the amount exactly 3 lakh pounds in 6 months time, in 1 days time. Okay. So for that, now all the working has to be based on this. From where will he get this 2,87,000 pounds? He will have to borrow that amount. Okay. Okay. So company to borrow. People a lot of time in forex try to rectify these steps, mug up these steps. Keep this system. It's very logical. It's very logical. If you understand it logically, you will able to get full marks in these steps. Okay, trust me. So company to borrow pounds 287,081. Why? Because company is in US. His home currency, uski home currency kya hai? What is his home currency? Dollars. He doesn't have pounds. So to deposit pounds today in the UK bank, he will have to borrow that amount in pounds today. Will somebody give him the pounds today? No. It's the US company, US country. So you get the loans only in your home currency term, means dollar terms. So to get this 287.81, first you need to convert that into US dollars. Okay. So what is the dollar rate which is going on, guys? Spot rate is 2. Okay. So to have 287 something to be put in the UK account, first you need to borrow that amount in your home currency. And what is your home currency? Your home currency is US dollars. So please convert that. Okay, clear? Company's home currency is US dollars. So borrow in US dollars. What is the amount? 287,081 into 2. So they will borrow dollars 574,163. Can I take this directly? Okay, because it is coming 0.67. So let's take it like this. No decimals. Okay, for easy understanding. Okay, this is done. 574,163. They will have to borrow in the US dollars. And if they borrow it, how much will they pay? Okay, amount to be payable. Okay, so you're understanding, na? You have borrowed in your home currency 5,74,000 something. You received that amount, you converted that into pounds and you deposited in your UK bank account. After interest, this 287 becomes 3 lakh pound and goes directly to the creditor. Simple. Your task is over. So you have to see what is the amount you will have to pay after when it is in your home currency. In your home currency means in dollars. Okay. So you are making the payment in dollars, 574,163. Now let's see what is the borrowing rate in the US is 5.5. Can you see all? This is your home currency. Okay, this is your home country. This is the importers. This is your creditor. So you are depositing here and you are borrowing from here. Okay, at the rate of this rate. Okay, 5.5. 574,163 and 1.055. Okay, so you end up paying $605,742. I'm taking it in the rounding of scenario. I hope that's clear. Okay. No doubts? Okay, chalo, let's move ahead now. Okay. Can I rub this or should I wait for a minute? Okay, I'll wait for a minute. You just do that. Okay, clear? So we have done 3 things. Okay, we have to do one more thing so that we can evaluate our answer. We have done no hedging with the help of expected rates. We have done the forward cover with the help of the direct rate which is given. And the third one, we have done the money market instruments, a money market cover. Now the fourth one is option, and this will be little tricky, very little tricky. Okay, because that you will be using the concept of your derivative chapter from here. When to exercise and when not to exercise a particular thing. So are we all ready? Any doubts? Should we see? Okay, no doubts as of now. Sairam. Okay, very nice. Okay, he's shared an answer. So thank you so much, Sairam. Thankful to you. Okay, so let's now try for the options. Let's first go to the question. So the thing is that a call option on pound, good or bad, call option on pound is given. Buying a call option pound gives you a right to buy the pounds, and that is what is required. In the previous question, it was not given directly, it was given indirectly. So we said, we can say here, key call option to buy pound, or you can say put option to sell dollars. Both of these things. So here directly it is given that the call option will expire in 20 days, having the exercise price 0.97, I'm paying the premium of $0.04. So it is good. All are given as per our own requirement, so we don't need to do anything. Okay, so we will buy a call option that we can buy this at 1.97 exercise price 0.0. Okay, this is what we have to pay. Right to buy. Okay, no doubts. Can we move to the board now? Can I rub this? Fourth one, B part. Using options. Payment is in pounds. Okay, payment is in pounds. Okay, so what does that mean? That we have to buy pounds. Okay, we can say buy pounds means sell dollars means the same thing. So if we buy the pounds, just in take, we buy the pounds. So what we need to do? We need to buy call option, or we have to say we have to buy put option for US dollars. Terms in the question are as per pounds, so we will buy the call option. Clear, guys? Simple. And we have to see that there are some expected rates as well. So whether to exercise it or not, we can see that. Okay, so buy call option. Okay, now this is the expected price, and this will be our exercise or not. Okay, and if so, what at the price it will be there, probability and total. So beta, see, if the price is, let me show you the assignment. If the price is 1.91, will you exercise it or not? Now be very, very careful when you are answering this. Do not ratify. Anything can come in the exam. Okay? Spend about 2 minutes. It will be worth your time. Spend about 2 minutes here. It will be worth your time. For sure. Okay? For sure. What am I saying? Whenever you are confused, you can do a calculation in your exams. Okay? You have to make a payment? Yes, sir. If something is available in the market as one, what is this thing? At 1.91, will you make the payment at 1.97? Sir, we did not understand. Wait, listen to me. Yes, sir. How much are you supposed to make the payment? Sir, 3 lakh. 3 lakh into 1.97. You have a option to exercise at 1.97, means you can buy a currency at 1.97. Okay. So will it result in a larger outflow, cash outflow against 1.91? Yes, sir. If you make a payment at 1.97, how much you will be paying? Sir, we will be paying 5,91,000. If we go for that option, there are three choices, that just in case after 1 days price becomes 1.91, will you exercise it or not? This we are doing. Okay, so if we exercise it, our outflow will be 5.91. If we lapse it and we take the actual spot price, we will be taking the payment at 3 lakh into 1.91, which will be much lower amount, 1.91. So we will be paying at 573. Nobody is a foolish that he will be making a payment someone at 1.97 when the actual spot rate is 1.91. He will say, I will let this option expire even if I have paid a premium of 0.04. Is it clear or not? Because if this is clear, everything going to be clear. Okay? Thank you, Naveen. Thank you so much, Naveen. So this is the thing that you have to see in the exam. Okay? This is the thing that you see. Whether exercising is beneficial for you or not, that is the most important thing. Okay? So why would you exercise something at 1.97 when you can make a payment at 1.91? This must have been taught to you by the derivative class. Okay, so let's take that back. So if the price will be 1.91, we will exercise it? No. We will not exercise at, let me write over here, 1.97. So you compare this price and this price. So you will not be exercising. What price you will exercise at? 1.9. When the probability is of 25%. Clear? When the probability is of 25%. So what is the probability that your expected outflow will be? Just like the one we did for the first one. So if it becomes 1.91, the probability is 25%. Means the probability is 4.4775. Sir, but we have lost a premium of 0.04. This is what we taught to you in the derivative chapter. That premium gives you a right to buy or sell. You pay the premium and then it is up to you. If you like it, then it's fine. If you don't like it, just ignore it. Okay? Yes. So 1.91, you will not be exercising. 1.95. Will you make a payment to someone at 1.97 when the price is 1.95? No, sir. We will not exercise it. We will lapse. At what price you will making a payment? 1.95, which has a probability of 60%. Okay? And the outflow will be 1.95 into 60%, so 1.17. Okay? Next is 2.05. Will you, if the spot price becomes 2.05, will you exercise your option? Yes, sir. Will you exercise? Yes, sir. Why? Because even if the price is 2.05, we still have a right to make the payment at 1.97. And the one which has a lower cash outflow, this payment come hoti hai. The one which has a lower cash outflow is beneficial for the firm. So we will exercise it, yes. And what price? 1.97 price. This price when you make a payment that has a probability of reaching at 15%. Clear, everyone? 0.2955. Four, 1.943. Has everybody got this answer? Students? Clear? No doubts? So, if this is clear, can I rub this? If this is clear, 1.943, everybody has got this rate? Okay, fine. So, expected cash outflow after 180 days. 3 lakh pounds into 1.943. This we just calculated. अभी रब करने से पहले we just calculated, right? Okay. So we paid 582,900. This is all in dollars, okay? All in dollars. And you will have a premium as well over here. Okay, premium as well. Okay, 0.04 per USD. Okay, sorry, 0.04 USD per GBP per pound. So you will be paying a premium of 3 lakh into 0.04. This was easier because the currency matched. So we bought a call option. If the currency doesn't match, you buy the put option. Just like I told you, if the base currency is same, you multiply. That becomes easier. Otherwise, you divide. So similarly, if the currencies matches up, in between, आपस में, so you buy the call option. Otherwise, you buy the put option to sell your home currency to buy the foreign. The previous question. This is the easier straightforward question. But here some other things become stuck. No? So what is your total outflow, beta? 594,900. Done? So can we compare? 594,900. So can we compare? $594,900. Okay. Can somebody give me the answer of money market hedge? How much did we calculate for that? Because I have already rubbed that amount. So 586,500. Okay. There the rate in forward was 1.96. 5,88,000, right? Okay. Okay. Thank you so much. 605,942. Okay. I hope that was along with the interest, right? 605,740. And you have 594,900. So which results in the lowest cash outflow, beta? Without hedging? Okay. So that prevails, the very first answer. If the 180 days rate is expected to be as per company's expected probability, because there also the company has made certain assumptions. Okay. if one day is expected to be as per company's expected probability, then no hedging shall be the best alternative. Because this reduces your paperwork. This will reduce your lot of what do you call this, calculations, depositing the money, all those transaction things will be there. And in option, very major things comes is your 12,000 cost as your premium to exercise the option. So that's a big thing here. Premium is a concerned amount. Paperwork and depositing those amounts will be a different work. Paperwork will be here as well. Here we don't require any paperwork. If the movement becomes similar to the expectation, that is, it could be 1.955, then I think that will be the lowest possible option. Okay. So let's see. I'm done with that. Let me just see. Okay, sir is here although. Ashish sir, if you are there, I am actually complete with the concepts. Okay.
Okay, Sushant.
Thank you, sir. Yeah, please.
So you have completed this foreign exchange topic?
Yes, sir.
Okay. I hope the students, the topic must be very much clear to you because Sushant sir has explained each and everything in a very detailed manner. Now, some one or two queries are emerging from the doubts of the student. I want to discuss with you students. There was some, this is a common doubt. I'm just sharing with you, this is a common query. There is one common query, is how up to how much decimal point we should take the quotation. This is a very common. So from examination perspective, student, please note, if any instructions has been given to you in the exam, so you have to abide by the same. Okay, they say 4 decimal point, you go by 4 decimal point. They say 3 decimal point, you go by 3 decimal point. There is no problem. Now, if no instruction has been given, then you have to see what is the quotation. If quotation is in the 2 decimal point, so you should limit your answer to 2 decimal point only. If it is in quotation in 3 decimal point, then you should limit your answer to 3 decimal point. And if it is in 4 decimal point, of course, you have to limit your answer in 4 decimal point. There is another one important catch here, student. There is one FIDI guidelines in this regard. According to FIDI guidelines, what happens? You have to round off your quotations into 0.0025 multiples. So if it has been mentioned in the question, you have to follow the FIDI guidelines. So please note, you have to round off your answer into the multiples of the 0.002. That is a one important point. And next, another doubt mostly comes into the mind of the students, sir, how we compute the exchange margin, because exchange margin is basically kind of a administrative charges that is normally charged by the bank for the administrative purpose only. So suppose if we are computing any cross rate, so of course sometime in some question you will see that it is computed on the US dollar India INR rupee rate, and in some cases you may find that we have computed on the for any foreign currency like say Hong Kong dollar or India INR. In both cases, whatever practice you follow, no marks will be deducted for the same. So you can follow either of practice because it is hardly matters in the exchange rate. So in case you have any doubt, so student, just write down our email.
Sir. Yes, sir. Yes, I'll just write, sir. Yes, sir. So student, as sir has said, please note this down. I'll just clear the screen.
Is it SFM final? SFM dash final. Not SFM.
Oh, sorry.
SFM dash final. It is continuation in, okay, @ICA.in. And my contact number is, I will directly connect 0120 30 45 956. So even you can contact me over the telephone for your clarification or doubt. Okay, student. So I think now, Sushant, you will in the next class you will discuss the topic of international financial management.
Yes, sir.
Yes. Now the whatever in the next class when we shall discuss this topic, so you see the beauty of this topic. Capital busting you have discussed, or you can say financial management you have covered into your intermediate level. Now you have just covered your foreign exchange risk management. Now international financial management is basically a combination of financial management plus in the international scenario, that is plus foreign exchange risk management. So you will combine this topic and you will learn how we make the foreign investment decisions, investment in making investment. So Sushant sir will take the class, and please you attend the class on regular basis. And if you have any doubt, you can contact us. Thanks, Sushant, for your sparing your precious time and giving such a beautiful presentation on this topic. Thanks a lot.
Thank you, sir.
Okay, students, thanks a lot for your questions. Have a nice day.
Thank you, sir.